In this video, you will learn how top-down analysis helps you read the market from the bigger picture down to the entry. Instead of reacting to random candles, you will understand how a multi-timeframe approach reveals direction, structure, supply and demand, liquidity, and the key areas where price is more likely to react. We will break down how to combine market structure, liquidity, order blocks, and lower timeframe confirmation into a complete trading plan. By the end, you will see how reading multiple timeframes helps you filter weak setups, avoid lower timeframe noise, and focus only on trades with stronger probability and clearer execution. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Now, let's begin with the foundation. What is top-down analysis? Top-down analysis is the process of studying price action across different time frames, starting from the higher time frames and gradually moving into the lower ones. This method helps traders understand the broader market context first, and only after that, zoom in to search for more precise and higher probability trade setups. When using top-down analysis, there's three important time frames every trader should understand. The first one is the higher time frame. This is used to determine the dominant market direction. In simple terms, we want to know who is in control, buyers or sellers. The higher time frame gives us the overall trend, the major structure, and the broader context of the market. The second one is the analysis time frame. This is the most important time frame for planning the trade. On this chart, we evaluate market conditions, map out structure, identify key liquidity areas, and define our trading bias. This is where we decide whether we should be looking for buys, sells, or no trade at all. The third one is the entry time frame. Once our bias is clear, the entry time frame is where we zoom in to look for confirmation and execute the trade. So each time frame has a specific role. The higher time frame gives us direction. The analysis time frame gives us structure and bias. And the entry time frame gives us confirmation and execution. Now, let's break this down step by step. Top-down analysis always begins with higher time frame analysis. Before doing any detailed chart work, the first step is to look at the daily or weekly chart. These higher time frames provide a wider view of the market, helping us stay aligned with the bigger picture and avoid trading against the main flow of price action. The first thing we need to identify is the current dominant trend. Is price in an uptrend, a downtrend, or a range-bound condition? This helps us understand the overall direction of the market. Along with that, we need to highlight key support and resistance levels on the higher time frames, especially on the daily chart. These levels are important areas where price can react, reverse, or break through with momentum. Identifying these zones is important because the market is fractal. In other words, price behavior repeats across different time frames. A small reaction or structural shift on the daily or weekly chart can create a much larger movement on lower time frames. That is why, before taking any trade, we must always evaluate how much room price has before reaching the next important higher time frame level. The next important part of higher time frame analysis, especially when using the daily or 4-hour chart as your main higher time frame, is identifying who is currently in control, buyers or sellers. Why is this so important? Because if you do not know whether demand or supply is dominating the market, there is a much higher chance that you will trade against the real direction. To understand whether buyers or sellers are in control, we need to look at the most recent price origin. For example, if the market is in a downtrend and price is reacting from a fresh, unmitigated supply zone, then supply is in control. In that situation, we should mainly be looking for selling opportunities, not buying opportunities. Supply remains in control until price reaches a fresh demand zone and reacts strongly to the upside. At that point, demand can take control, and we should stop looking for sell setups. even if a lower time frame appears to show a perfect short entry. So, identifying who is in control always depends on how price reacts to fresh, unmitigated supply and demand zones. And always remember this: fresh higher time frame zones have priority over the time frame you are currently analyzing. This means that if price taps into a fresh, unmitigated higher time frame zone from the opposite side, control can shift from demand to supply, or from supply to demand. After completing the higher time frame analysis, the next step is to move into the analysis time frame, such as the 4-hour or 1-hour chart. These time frames are one of the most important parts of technical analysis, because once you understand how to read them correctly, you can avoid many common traps and make better trading decisions. The reason we use the 4-hour and 1-hour for market structure mapping is that they are mid-range time frames. They usually do not create as much noise or misleading information as lower time frames, which makes their structure more reliable and easier to interpret. At the same time, they react faster than higher time frames, which makes them very useful for intraday analysis. To perform proper analysis at this stage, we need to identify market direction by focusing on the major highs and lows. This helps us determine whether price is in an uptrend, a downtrend, or a consolidation phase. Once we understand this, we can build a much more accurate intraday bias. After identifying the overall direction and the major swing points on the chart, the next step is to mark any breaks of structure, and then look for possible market structure shifts or changes of character. Once the market structure mapping is complete, we need to identify key points of interest inside the analysis time frame. These are areas where price has the potential to react and respect. A point of interest can be a fair value gap, an order block, a breaker block, a mitigation block, or an inversion fair value gap. For example, on this 4-hour euro-dollar chart, the most recent bearish break of structure is located right here, at the origin of the bearish move that caused this break. We also have a strong inefficiency in the same area. Together, this gives us a potential order block. A bearish order block is the last up-close candle, or a series of up-close candles, formed before a strong bearish move that causes a break of structure. So here, I will highlight these two up-close candles as my order block. This creates a fresh supply zone, and this is exactly where we want to focus our attention. This can become an ideal area to look for short opportunities if price pulls back into it. Now, after completing these steps on the analysis time frame, you should have a clear understanding of market sentiment and what price is more likely to do next. At this point, we begin looking for the actual entry. This is where the entry time frames, such as the 30-minute, 15-minute, 5-minute, or 1-minute charts, come into play. Depending on the analysis time frame being used, we zoom in even further to look for confirmation signals before finally executing the trade. The main reason we use lower time frames for execution is simple. They provide a more detailed view of price action and often allow us to achieve a more favorable risk-to-reward ratio. Now, first things first. After moving into the entry time frame, we need to wait for price to tap into the area of interest identified on the analysis time frame and show signs of rejection. Once we see that rejection, the next step is to look for a market structure shift or a change of character. After the market structure shift is confirmed, the next step is to identify an entry model. This could be a fair value gap, an order block, a breaker block, a mitigation block, or an inversion fair value gap entry model. The model you choose depends on your trading plan and personal execution style. We have already covered these entry models in other lessons, so if you want a deeper explanation, you can watch those videos separately. And finally, after identifying the entry model and the entry zone on the lower time frame, we can use that area to open a position and execute the order. The entry time frame can also add extra confidence and confirmation to the trading setup, helping increase its probability of success. You can strengthen the setup even more by looking for additional patterns, double sweep confirmation, or by using tools such as the volume profile indicator on the entry time frame. Now, in terms of time frame selection, if you use the 4-hour chart as your analysis time frame, the 30-minute or the 15-minute chart can be used as your entry time frame. If you use the 1-hour chart for your analysis, then the 5-minute or 1-minute chart can be used for execution. And if you use the 15-minute chart as your analysis time frame, then the 1-minute chart is generally the best choice for execution. But keep this in mind. Your analysis time frame should always be significantly higher than your entry time frame. This keeps the analysis structured and helps prevent you from making decisions based only on lower time frame noise. Now, in this example, because I am using the 4-hour chart as my analysis time frame, I will use the 30-minute chart as my entry time frame. On the Euro-Dollar 4-hour chart, we have an unmitigated bearish order block. This gives us a strong area to look for short opportunities if price taps into it and then shows rejection on the 30-minute chart. At this point, I move down to the 30-minute chart to monitor price action more closely and wait for confirmation. What we want to see is straightforward. Price should tap into the 4-hour order block, reject from that area, and then create a market structure shift on the 30-minute chart. As you can see, after tapping into the higher time frame supply zone, price reversed and formed a clear market structure shift. This shows that buying momentum is weakening and sellers are starting to take control again. So our 30-minute bias turns bearish, and we can begin looking for short opportunities. Now, if you look closely, we also have a bearish order block inside the 4-hour order block. This 30-minute order block was formed at the origin of the market structure shift move, and it was created by these two up-close candles. So now we have the 30-minute entry area we were waiting for. With these confirmations in place, we can anticipate price to retrace back into the 30-minute order block before continuing lower toward the sell-side liquidity. So here's the plan. I am placing the entry at the lowest point of the order block, with the stop loss positioned a few pips above the high. For the take profit, I am targeting the sell-side liquidity below this swing low. Now let's play out the chart and see how this trade develops. As you can see, the order was triggered after a brief drawdown. Then price reversed, moved lower, and eventually reached the take profit as expected. This example shows how combining multi-time frame analysis with a clear roadmap can make your trades more informed and your trading process much easier to follow. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the ComLucro Trader Community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts, it's about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.